Okay, it says I am live. Not sure if I am. It looks like I am. Okay, great. Just looking over at my screen there. Excellent, excellent. Is this thing on? Yeah, just let me know if you're seeing me okay. Good morning. Good afternoon. Good evening. Excellent. All right. Thanks, everyone. So, in this video, I guess in this live stream, what I wanted to do was run through my Palantir valuation model. And so, I've been working on this model for a while now. May have been 2022 when I started it. And the idea with this is to create a professional grade Palantir valuation model that we can use to evaluate against analyst expectations. So we use all of the professional inputs that you would use, such as a weighted average cost of capital. We model out every single product line for Palantir, which is government, commercial. We build a DCF. We model out the key drivers to build the DCF. We have comparative companies that we're using, funnels into an income statement and everything like that. So I've already made this model, but in this live stream, I figured it would make sense for me to update it in real time with all of you watching instead of just doing it on my own, so we can talk about the inputs and have a discussion along the way as well. So let's get started just looking at the overview here. This is outdated. So I believe the last time I updated this was in 2023. And you'll see our current price is, let's actually check the current price. What is it right now? 20, we're just going to round it to $21. So the model is currently showing a negative 15% upside. So that's a downside of 15%. And what we're going to do here is update all of the inputs, and then we're going to update the two valuation numbers there. So fully diluted shares outstanding, you'll just see me looking over at my other screen here for FactSet, which is going to tell me all of the numbers that we need. So fully diluted shares outstanding, this is a good sign. It didn't go up too much in the last quarter, 2492. So they have a little bit of dilution there. And then what is our cash balance? I know it definitely increased last quarter. And again, the reason I'm doing this now ahead of the Q1 numbers is because I want to be able to get it out to all of you, as well as check my own expectations to make sure I am, on the right side of things in terms of my expectations. So a little bit of minority interest. I'm actually not too sure. It's so de minimis that I don't even focus on that, but I'm not sure what it exactly is. I know it's some of their investments, and I think maybe the joint venture that they have. But anyway, this page is now up to date. And again, what I have currently is showing a target price of $18 per share. And I don't expect by the end of this to have a target price that's $30 per share or higher, because this is using like the very, I would say, very traditional valuation metrics, in the sense that it's very conservative and it's difficult to get a high valuation. It's not a, and because it's also the other thing is, with the discounted cash flow, you're obviously discounting the price to present day. So even with a a 25, let's say, dollars per share price target, that would mean I would expect Palantir to be worth $25 today. Not that that's a target 3 years from now. So yeah, let's get started. Actually, I want to do the comps first, because this is going to be easiest or quickest rather, in terms of what we're looking at here. And so, yeah, so the comps that I have here are Tyler Technologies, Datadog, and MongoDB. So Tyler Technologies um, is a government contractor that does, some software stuff. So that's why I've used them as a comp for Palantir. And what I need to do now is update what is their, or we can do Palantir first, Palantir's enterprise value. And then we basically compare that against these these comps and to see how the market is valuing these companies, and then to put that onto Palantir, like what would happen if Palantir was valued just like these other companies. So what we're going to do is look at the fiscal years. So next year's revenue for Palantir, based on analyst expectations, is expected to be for 2025. Um, Yeah, so that's the other thing. So I was in 2023 when I was making this, and so now I need to take the 2024 numbers and turn them into 2025 numbers. So this is gonna be interesting. Right now, it's showing an implied share price of $18 per share, and we're gonna have to see um, yeah, I agree. DCF, just looking at some of the comments here, a DCF model, the value in it is not predicting 10 years out. It's more of just making sure that the investment itself is solid and you're going to get more upside past the DCF. It's just good to make sure that your inputs actually have some sense behind them. So as I was saying, I'm changing these numbers. So we're rolling forward to 2025. So analysts are expecting $3.2 billion in revenue for Palantir. So that's a 15 times next year's revenue multiple, which is, sounds better than, what are they, above 20 or around 20 for this year. Um, so, yeah, obviously the multiple declines as you look further out. Now Tyler Technologies, let's have a look at this one. Hopefully you can see this okay too. I'll zoom in here. So their enterprise value, um, and this is exactly the type of thing that, Wall Street does, make sure they're triangulating their valuation. Now, they're not always super accurate, obviously, but these are the type of things you want to be doing um, as a retail investor to at least understand valuation methodologies. It's just my opinion. So their enterprise value didn't change too much from when I last looked, but let's see how much they're expected to grow. From 2.1 billion in 2024, they're expected to only grow to 2.32, 2322. So they have um, a low growth rate, and this is because they're definitely not growing as fast as Palantir. I would have predicted that, right? But it's it's actually surprising. Their multiple is a lot lower because their growth is a lot slower. So this is going to drag down the implied share price because of the lower multiple. So we'll see if it's worth keeping them in or not. Datadog, however, they're a high multiple company because they have some pretty high growth. So we're about to see, and I'll get to questions in a moment. Let me just finish this section here. So Datadog's sales for 2025 looks like it's going to be 3161, so pretty close to Palantir at 3 billion, but we need to update their enterprise value. 43094, 43094, if I have that right. I believe I do. So this is good because with comps, you want to find something that's ideally in the same sector, in the same subcategory, as well as something that's, relatively the same size. Because when you have, Microsoft, for instance, you can compare it to Palantir, there's such a gap in the size of the businesses that you're not always sure if that's an equivalent, if what the multiple would do if Palantir was the size of Microsoft. So you see what I'm saying is Palantir and Datadog are pretty much the same size in terms of an enterprise value, and they're having pretty similar, um, revenues, and as a result, their multiple. So it's a pretty good sign that we can look to Datadog and they're going to trade pretty in line in terms of if Datadog gets a richer valuation, Palantir is going to get a boost as well. So now let's look at MongoDB here, another data analytics. So the problem that we're seeing is that a lot of these, like Splunk, for instance, and some of these other analytics companies have actually gotten bought out. So there aren't as many to compare now. They're trading at 25 billion, which is a bit less, compared to these other, at least Datadog and Palantir. But let's see their estimates for 2025 revenue. Okay, it looks like they label it as 2026, but they're expecting 2.3 billion. Okay, so this is going to be interesting because Palantir has the highest multiple here. Let me shrink this down. Yeah, so what you want to do from here is to say, not just like average these, because right now the average, it says it right there, 11 times, which is, if we put Palantir at an 11 times, that's going to be a significant decrease in evaluation for Palantir. But that's not what you do, because Palantir has, a number of different metrics that are better than these companies. And I've looked at other comps as well, and maybe in the future I'll add more, because you generally want more than 3. You probably want 5 or a decent handful amount. But anyway, I'm getting off track. Let's wrap this part up by saying Palantir, in terms of the numbers I had pulled previously, I'm just looking at, so Palantir's revenue CAGR, I was just confused, so looking at this column here, has grown 37%, Tyler has grown 19%, Datadog's grown 70%, and MongoDB has grown 20%. So what we do from there is pull a percentile to say, like, where does Palantir fall within these? And it's pretty close to the 65th percentile. It's just an approximation, right? Palantir's 37%, it's pretty close to 35, so 65th percentile. As for gross margins, they definitely have good gross margins, which is closer to the 70th percentile. Now, hopefully all this makes sense. It's just, evaluating Palantir's fundamentals against these companies' fundamentals, so we can say what percentile do we apply in terms of the multiple. And then for a free cash flow yield, Palantir is a bit lower. Now, this is probably increased, so I could redo this analysis, but all in all, if we look between the 50th and 70th percentile, I sort of said they're about the 65th. And so our numbers actually did go down a bit for the comp analysis. So let me make sure this is working properly. 65th percentile. Sorry, I just had a cough there. So you can see what would happen if you change it to a different percentile. And you know what? It's really that Tyler Technologies is sort of weighing us down, because there's 7 times. And so what you have to think of for Palantir is they are not majority government. Now, the government gets a lower multiple. It's not high growth. So when you do a sum of the parts analysis for Palantir, you're giving a higher multiple to their commercial revenues and a lower multiple to their government revenues. Now, the good thing is Palantir has, only half of their business is government, and so the other half gets a higher multiple. So, I'm a bit surprised that that we're seeing a downside in the comps that's this drastic. Now, it's nothing crazy, like it's in the realm of expectations, but my response here is that we know Palantir has a premium valuation because it's product and market opportunity is greater than, Datadog, for instance. They're not reinventing AI within the enterprise to the degree that AIP is. So you would hear this analysis in terms of people saying Palantir is overvalued from a comps perspective from pretty much anyone that's being honest with you. But that's not the point of this. That was just something I wanted to do right away. And obviously, you can plug in other companies if you wanted. That would really give a boost to Palantir's valuation. But this is just a very small thing I wanted to open with. And next we're going to get to the actual modeling, which is a lot more important. But first, let me check the chat here and just give this thing a quick read. So yeah, thank you all for joining me. And yeah, check out the link if you want to download it for yourself. Anyone that has purchased it previously, I'll be sending out this update today once I make these modifications. Okay, cool. So let's get going here with the DCF. Again, my goal here is to be as accurate as possible. I'm not selling the stock. I don't get a commission from Palantir for selling you stock. And you know what's interesting as a tangent here is we all think of, in terms of being retail investors, of supporting the companies that we own stock in. But it's interesting for Palantir, they don't really need our money, right? Because they have cash, they're free cash flow positive. The only way that you benefit a company, in my opinion, other than being a brand ambassador, is by bidding up the share price so that they can then sell stock or do some sort of capital raise. And in Palantir's case, they don't need to do that. So thus debunking the fact that they are paying Palantir YouTubers, which is definitely not the case. So this is what my DCF was saying previously. Palantir had grown, 44% in 2020, 41% in 2021, 24% in 2022. And what we have to do here is turn this year is no longer an estimate. We have to turn this year into historical performance. So this is going to take a little bit of work, and then shift everything forwards to make sure that we're forecasting a full 10-year period going forward. So what we're going to do first is focus on the revenue build. So this revenue build is saying, what are the expectations for Palantir's revenue segments? What are we saying that they are going to grow at in terms of percentage growth? So as I said, 2023 is no longer a forecast year. It's in the books. So we need to make it a historical year. So let me add that column. Copy this. It actually probably makes more sense if I'm actually going to do that later because it's going to take a bit of work. So instead of wasting your time with that, what I'm going to do is I'm going to add that later and upload it later. But what's more interesting here is the forecasting the assumptions, right? Okay, so I guess I have to change that to 2024. Made this model a long time ago. So what we're going to be doing is forecasting the years 2024 through 2033 as a 10-year analysis. And so again, I'm going to go in and add the number from 2023 so that it all fits together. But basically, what I'm going to look at is what the analysts are expecting PLTR on a fact set as an average, as a mean expectation, and then modify my expectations from there. So I expect my expectations on growth are going to get farther and farther apart from consensus, but only over time, because analysts aren't going to be wrong by 50% this year. It's just not possible. So let's take a look at this. What I'm seeing here are the expectations for growth for 2024, 2025, and 2026. So they expect Palantir to have 1.4 billion in government sales this year. 1.4 billion. So let me anchor around that. What is that expectation? 1.4 billion. Now, because I'm missing a year, this first number is going to be off, but I don't want to waste everyone's time on that. And then in 2025, they expect government to be 1.6 billion. Okay, 1.6. So that's looking like, oh wow. Okay, so only about 14% revenue growth. And then from there, they don't have it split, but what we do have is the total number of revenue. So let me just do commercial, and then we're going to build out the rest of the years. They expect 1.3 billion in 2024 for commercial. So what does that look like? 1.3. I'm just anchoring my numbers here, and I'm missing a year, which is why the numbers are off. But it's not going to mess up the analysis at all. I'm going to go in and fix that later. Okay, and they expect 1.6 billion in commercial. So analysts are expecting commercial to surpass government in 2025. That's a big deal. That's a very big deal. 1.6. So, yeah, so they're only expecting 14% revenue growth for government in 2025 and a 24% revenue growth for commercial in 2025. So now I'm going to have to adjust my expectations. And how did I do this? Base is on the top, then bear, and then bull. Now I'm not expecting much variation from base, bear, and bull for this year, right? So going forward, going past that, I will give some variation to it. So base 14, I am going to go above analysts here. Bear, we'll just say bear case, the analysts are right, and then bull case 16. Okay. Now for 2026, how do we expect government growth is going to happen? I'd love to know what everyone thinks. How is government going to go? Is government going to grow? Is government going to grow faster than 15%? I think we're going to just, you see my previous numbers are a lot higher than this. I think in 2026, I'm going to say that, well, let's say it does increase again. 15, 17. But then after that, I'm just going to have it stay pretty steady, actually. We'll just have it steady for a while. We'll say through the rest of the decade, it's flat. And after that, it starts to decline. 15. And I think this is very conservative, actually. But I'd love to know what all of you think. We're going to do 13. We're going to do 15. Okay. We'll just go with that. So that ends us with 5 billion in government revenue, but that's 10 years from now. So 10 years from now, Palantir has 5 billion in government revenue is the expectation here. Again, I might have to come back to this and make some modifications because that sort of sounds a bit low. 1.4 billion to 5 billion. But as we know, government is not the growth story when it comes to Palantir. Let me just take a sip of water here. All right, now on to the more exciting part, which is commercial business. So they've grown 30% in the past before. So yeah, I'm a bit surprised the analysts are only expecting 24% in next year, which is crazy because I think 2025 is going to be the year where AIP starts to impact the financials. Now, analysts, and this is why we do this analysis, are not expecting that at all. 24% growth is definitely not pricing any of that in. So, given my understanding and research of the company, I'm going to raise this pretty substantially. So right now we have base of 24. We're going to keep the analyst expectation as the bear case. So let's say they grow 30% in the base case. They've done that before, right? And now they have this new revolutionary product. So let's do 35 in the bull case. And you'll see this is pretty consistent with my numbers before, but this is sort of pre-AIP numbers, seeing the impact of it. So what I'm going to do is we're going to have to lower the bear case a bit so that it makes sense. So we'll say we'll just do the bear case first, 25%, 26%, 27%, and that's sort of where it peaks mid-decade, which I think makes sense. When is Palantir going to be growing the most? It's going to be in 2028, 2029. Let me just zoom out so we can see that. And then bear case, they end up commercial growth down at 22%, and their government growth down at 13%. So I think the bear case is looking pretty good. So yeah, so why do you think 30% is high? The analysts are expecting 24, and 2025 is when AIP is going to hit the financials, in my opinion. So are you I'm just reading a comment here. Are you unsure of the impact of AIP? Because we know how many customers they've onboarded. They just haven't been brought into to being paying customers yet. And so I think 30% could end up looking low. But I do want to have a conversation here. So yeah, let's keep going. What are we going to do in the base case? We'll do 31, 32, 31, 30, and we'll just march it down. I think that's good. We could do 29, 28, 27, 26, 26, okay. And now we need to do the bull case. So for the bull case, this is going to be interesting. 35%, 34%. You know, for the bull case, actually, I'm going to do, it's not as much of a spike, but it's a bit of a like an increase towards the middle of the decade, like I was saying. And then after that, we sort of see the cool down, 32, 30, 28. Yeah, I like that. I like that. So for that, let me just read the comments here. I think it's just now all hype. I'm a bit scared to put that number in. Yeah, that's fine. You just have to understand that that AIP is being priced into the multiple. Remember when we looked at the Palantir's 15 times revenue multiple? That's pricing in some AIP. Because why wouldn't it be down at 13 or 11 times? Without AIP, I think it would be. And so that's what you have to be cognizant of. However, the point of what I'm saying here is the analysts, when they say 24% growth, are not factoring it in. So the multiple is saying Palantir's going to grow a lot more than the analysts are. And when Palantir beats the analyst numbers, you think the stock's going to go down? I don't. Okay, let's see. What does that end us up with? That's 16 billion in the bull case, 10 billion in the bear case, and 13 billion in the base case. Now, those are very big numbers. Those are certainly very big numbers. But those are 10 years from now. So, yeah, looking at the size, maybe I do need to bring that down. But that brings us to total for 10 years from now. 18 billion in the base case, 15 billion in the bear case, and 22 billion in the bull case. So, yeah, we're about to find out what that turns into in terms of a stock price. But here's the blended growth rates for the decade. 22%, 24%, 25%, 25%, 24, 24, 24, 23, 22. So this is just saying Palantir grows mid 20% in terms of revenue, which, granted, is very difficult to do for an extended period of time. I'm not saying it's easy. It's definitely not easy. It's definitely very difficult, but I believe Palantir is up to the challenge here. And this is, as I was saying, percentage of revenue. Government's on the top here. The analysts are saying commercial is going to flip government next year. This is probably something we'll be hearing about shortly from Alex Karp on the call. And then it's just going to be further exacerbated, and a quarter might be government revenue in 10 years. Sense check, that sounds pretty sensible. That sounds pretty sensible to me. And yeah. What about the gross margin? I'm not too sure there's anything I need to change here. 81%, sort of ramping up to 85%. It's pretty generous. 85% is pretty generous. I don't think there's anything I need to adjust. I think Palantir already has an incredible gross margin. They're going to eke out some more gains from it overall, but it's definitely not going to be 90%. So this is our revenue build that we just completed. Now I'm sure you disagree with many parts of it, which I think is great, because we should all have our own models here. Now we're going to dive into the drivers. Okay, just modify this and come back to it later. 2024 through 2033, once again, what are our expectations for them spending on selling, general, and administrative? Now, this includes marketing, which Palantir doesn't really do, but it also includes general and administrative expenses, which is largely salaries. So as a percentage of revenue, we've actually seen this decline pretty sizably over time, and I think this is going to continue. SG&A as a percentage of revenue. Palantir is going to get more efficient with their spending. And the question is, do these numbers make sense? 58% down to 43%. I think, yeah, I think I'm going to keep these for now, and we can come back to them in a moment. As for R&D spending, I probably want to increase R&D. Now, why would I increase R&D? Well, I increase it because Palantir is going to be spending pretty substantially on R&D in order to maintain their competitive advantage and lead. And they want to keep the best talent in the business. So, yeah, let's say it doesn't drop so substantially. Let's say base case 16, 15, 14, and then let's just keep it at 14, 13, 13, 12. Let's say it doesn't go below 12. There we go. Bear case, we're going to have a higher R&D, meaning they're spending less efficiently. 18, 17, 16, 16, 15. Let's actually just keep it at 15 for all of the years after that. 14, 13, 12. This is the bull case. 11, 11, 10, 10, 10, 10. You know, the thing about the bull case is that they're growing a lot. So I'm actually going to bump the bull case R&D as percentage of sales to 14 for all of the years, just to say they're just going to always be spending that. Yeah, okay. DNA, not relevant. Stock-based compensation, I've already sort of thought about this a lot. So have it really falling down over time, but nothing that's going to impact too much. Tax rate, you could certainly play around with. CapEx as a percentage of sales. Again, this isn't too important. And so that just populated our income statement and balance sheet. And yeah, working capital, sort of not that important. Okay, so what we have here is the update to our, there we go, to our DCF. Let's look at this. So it's saying an implied share price of $20 per share. Basically, what we have here is all of the expectations together, and it's showing the revenue growth and the margins that we had said, and sorry, I was just distracted for a second. So basically, those are our numbers here, and the unlevered free cash flow of 260 million up to 5 billion, roughly 10 years from now, as a percentage of sales. Free cash flow as a percentage of sales, and that's what we see there. And so that's what generates our $20 share price. So my question is, why is that so low, right? If we're expecting substantial growth. The answer is and another reason DCFs are difficult, is these are Palantir's GAAP numbers, meaning they are including the stock-based compensation as an expense, which is a non-cash expense, but nevertheless, it's including it as an expense that is being realized. So normally, like Wall Street, for instance, doesn't really do this because they'll just put a multiple on a year. And we can do this too. But like in an academic setting, you would always want to include the stock-based compensation because it's an expense to shareholders. but it's not an expense to the cash of the company. So let's say revenue growth, we can just put a multiple, or not just growth, but just revenue that we forecasted. We can put a multiple on this. So let's say revenue, or we'll just do price to sales. Excuse me. Let's just say, where do we think Palantir is going to end up for a price to sales? Probably, let's look at what Microsoft is right now. Microsoft. Because, I like to use Microsoft as a comp in terms of where Palantir could end up in the long run. And that'll give us a better sense of what an actual share price is going to be. Financials, ratio analysis. Let me just pull this up 1 second. Actually, let me just Google it so it's faster. Don't have to work with the Microsoft price to sales. They're trading at 14 times price to sales. So let's be conservative and put Palantir at 12 times. 12 times sales for all the years. And we're going to see what that does. Dividing by the shares outstanding. So look, that puts Palantir at worth 13, which is, an oversimplification. Sorry, I need to anchor my my number here. I'm a bit under the weather. Okay, so that's saying Palantir $87 per share in 10 years from now. Now, again, that's using a multiple that is less than what Microsoft is today. And Microsoft, you're not really gonna, I don't know why you would use a lower multiple than Microsoft for Palantir at any point in time, unless they get to be bigger than Microsoft, which I don't think is going to happen in the next 20 years. I mean, I don't know how you want to put it, but let's say they have Microsoft's multiple, 14 times. What does that look like? Yeah, $102 per share. And now obviously you wouldn't, like, what I can do here is we could say, what is our value? We could change this over time because it's not going to be stagnant. So we could say today it's 20, not percent number. We can do, in Excel, we can do this 20 times. We can say today it's 20, then 18, 16, 14, and we'll just keep it there because that's what Microsoft is. And we'll say, okay, let's just reference that and say, okay, what does the stock do? So there we are, right? Is this working properly? Yep. Okay, so that's basically how you back into the current share price of $22. And going forward, these would be expectations of what the stock might end up at if it's 14 times revenue. So you could change this and maybe they end up with 15 times revenue. I don't know. But the point is, this is the kind of thing you get into, and that's how you could see $110 per share. How do you raise that if you keep 15? It has to be higher revenue. And where would that come from? That would come from greater adoption of AIP largely. As we talked about, government revenue is, I would say, is definitely not going to be the growth driver in the sense that we already have a good expectation of where it's going to grow. Probably if we just look back at our revenue build, probably below 20% for every year here on out. Probably. Now, maybe not, but probably. So how you get the top line to grow substantially is going to have to be from commercial. So now let's do the same thing, but for, what should we choose here? Let's do operating profit, which is EBIT. So EBIT is earnings before interest and taxes. We can even do EBITDA. Palantir doesn't really have, depreciation, amortization is they're not a heavy manufacturing company. But the point of EBIT, operating profit, same thing, is we get a better sense of Palantir's core earnings power than compared to revenue. Now, Palantir has very high gross margins, right? So they get the benefit from that. So let's say what was Microsoft's EBIT EBIT multiple. And the reason I'm using Microsoft is because we want something to compare Palantir to 10 years from now. What is Microsoft's EBITDA multiple? Microsoft is trading for 23 times their EBITDA. 23 times, okay. So let's say Palantir is trading for 23 times in 10 years. What would they be trading for now? Probably 40, and we see this declining over time. Let me make sure my battery is doing all right. 35, 30, maybe I should not decline it so quickly. 34, 32, 30, yeah, this is looking good. 28, we just want to make sure it's a nice smooth curve because Palantir's multiple is going to compress over time, but that's as their business is expanding. So it all sort of works out. All right. Their EBIT times this number divided by their shares outstanding is going to give us our share price. EBIT times our multiple divided by shares outstanding as a rough approximation for a share price. Now, this isn't going to work great, right? Because in terms of today's value, Palantir is just now becoming profitable. And again, these are GAAP numbers. This is why it makes Palantir look bad. And that's almost why it's a more conservative in a sense it's really stress testing the numbers to make sure, like, is Palantir worth $5? Based on the DCF, certainly not. Based on the DCF, it's a fair value for the stock today. However, this is looking at, if you throw everything you can at it, stock-based compensation, GAAP numbers, how does it look? It looks like the floor for Palantir is probably around $20. But that's not saying the stock can't go lower than $20. It's just saying that's today's time. Okay, this is interesting. This is giving us a lower number. Now, why would this be? Because what is Microsoft's EBITDA margin? Okay, so their EBITDA margin's about 50%. Is that comparable to Palantir? No, I don't believe so. So maybe maybe that's not the right analysis, but if it was, it's saying about 50% lower stock price, $50 per share, which doesn't make sense to me. I think we usually see companies trading at like 40 or 50 times, but I wanted to see what that would look like. Excuse me. So let's say, just for the sake of argument, 50 times and then 45 times is probably, closer to something I would expect. So, yeah, That's what gives the $100 per share price. What else could we do here? Well, another thing I want to do is we can look at my expectations against the Wall Street expectations just one more time, maybe for anyone that came in before I did that. We get a better sense of exactly how much higher my expectations are than Wall Street. And the benefit of doing this now is that we're going to see how they change over time. And I've actually been, to my surprise, pretty correct, actually. And I say to my surprise because I don't know how I'm outcompeting people that have better information than I do. All right, let's get to it. My forecast, 2.7 billion in 2024, 3.3 billion. These are wrong. Okay, here we go. Okay, so this is my deviation on revenue expectations. Expecting a 1% beat in 2024, a 3% beat in 2025, and a 6% beat in 2026. Okay. Let's look at EPS. What are the street's expectations for EPS? 2024, 0.13, 0.21, 0.39. Okay, this is interesting. This might mean I have a mistake in my model to the downside, because I am not sure why I am getting lower numbers than Wall Street. Okay, I think I see it. So it's just because, once again, I haven't updated the so I just need to shift this 20 comes after X, Y. Okay, yeah, obviously. Here we go. All right, there we have my EPS expectations compared to the street, which is which is income, right? Income. And so I'm expecting them to beat it by 9% this year. It's only 1 cent, right? 1 cent. It's not anything crazy. And then 2025, again, what you always want to do is make sure when you're looking at the numbers, you want to make sure that your analysis is backed up by some thesis. Now, we all have our own Palantir thesis, but in this case, why am I saying Palantir is going to beat EPS by 7 cents? Again, I might need to tune this over time, but I'm saying that because I think that's when AIP hits the financials. And I'll keep saying it because I think it's going to happen. Whatever, 18 months from now. So, yeah. The question, though, is why am I lower in 2026? That doesn't make much sense. So there's certainly some tuning I can do over time here. Over time. Let's look at revenue per employee. Pretty interesting. And yeah, I don't think Palantir has that many employees. So let me update this. FactSet says they currently have 3,735 employees in the year 2024. So I was way overestimating their hiring. Way overestimating it. 37 is right now. So that's right. I think they did do a layoff in 2023. It must have been about around 100. So I think they are hiring. Wow. I was way off. Okay. Let's say it like that. So, yeah, revenue. H32. Let me make sure this is correct for 2025. All right, so this is off by a year. But anyway, you get the idea. The year might be, that's 2025 instead of 2024. But the explosion in revenue per employee is showing that Palantir, as employees, are delivering a lot of value to the stock, to the financials. What's on here? Sales efficiency. That's something I was playing around with, that I didn't entirely figure out. And so that sort of brings us to the end here. Working capital, balance sheet, income statement. So I think we covered a lot of good stuff here. The thing is that I need to do is just put in the year 2023. I should have done that before this, but I'll be doing it after. And anyone that's already purchased the DCF, it's $10. You get to download the file and everything like that and put in your own assumptions, which I think is very valuable. I thank you for your support if you choose to do so. I'll be sending that out as an update very shortly. But basically, we've, in this live stream, justified why Palantir's current price of $21 in that vicinity is pretty fair, in terms of the DCF. However, on the CompCo analysis, looking at our comps, what I probably should do here is include something like an NVIDIA instead of a Tyler Technologies. Because, again, when we see a multiple that's half of what Palantir's is, it's kind of an indication that's not as similar of a business. So that's on me. But I really do hope that you found value in this. And yeah, I really do hope that this is somewhat interesting. Yeah, thank you for the comments. I really do appreciate the kind words. That means a lot to me. And yeah, I just wanted to sort of talk through this. It's helpful to me when I talk through these sorts of things, and it's great to chat with all of you, get your feedback. May 6th is a big, big day. If you haven't seen my videos explaining it, there's many more to come. But I think May 6th is a very, very important quarter because we need to see customer count additions, growth rates. It's less on the EPS, but they're going to beat EPS, mark my words, because expectations are they're going to decline from last quarter. Doesn't make any sense. Again, I apologize. I will do another live stream when I'm feeling better, but I wanted to do this one because I had some free time today. And yeah, appreciate all of you. Hopefully this was entertaining in the slightest. And yeah, until next time.